Well, good morning, good evening, wherever you are. Hope you are having a good day and welcome in. This is a full breakdown of the market, and I have been waiting to do this video for a while because I've been traveling. Just to give you guys a kind of update. I had a great European summer this year. Had a fantastic time in London, Greece, Lisbon. Went for a music festival. Was in isolation for almost 7-8 days and disconnected from the internet and the grid, and that was a great experience. Lots of sound healing, meditations, dancing, everything in between, sitting by a lake and just recollecting the thoughts of this year. I think I'll make a separate video on struggles that everyone goes through, but the theme for this year has been pretty much solidified, which is we're in Trump economy 2.0, and all these drops that have been occurring, small pullbacks or big pullbacks, which this was a crazy 21% pullback, are great blessings for us to pick up great stocks at discounts. Quick little update on the small portfolio, which we started with 70K, currently almost close to 100% on that account. This was a small kids portfolio that I started last year around the same time, and it has done extremely well. Some of these positions with amazing returns, even Coinbase was just 100% plus just a few days ago, but it fell on earnings, something to do with that. I continue to hold all of my legacy positions here for into the future, as the macro environment is about to change drastically in the next couple of weeks. So that is kind of today's conversation. It's preparing you for what's about to come in the next couple of months, because I think that retail traders look at a lot of the information that's given to them on a daily basis, and whether it's paralysis or extensions or projections of their own fears and limitations onto situations, there is an underlying truth in the market that you need to read through context and through understanding of macroeconomic data to piece together the picture of the puzzle in which the market is forward looking 6 to 8 months from now. Okay, so let's kind of run through it. And I've built a little dashboard for myself on TradingView. If you're interested in this dashboard, I can send it to you. If you're interested, just comment down below on the video, and I will share with you the link to this dashboard. I think you can also, yeah, there you go. I can copy a link and share this with you guys. So comment below if you want this dashboard. I can share it with you. So non-farm payrolls. This has been majority of what has been discussed in the past couple of days, right? Where numbers got revised downward, and then the BLS, labor market head got fired by Trump. Now, there is obviously inefficiencies in the way that America measures unemployment. And that's something that, we've seen major big revisions over the past 2 years, multiple times. And then on top of that, there is, a very interesting, phenomenon that you can see from Nomura's report, which is from Charlie McElligott. You can see here, with both new orders and unemployment missing, contracting deeper, as well as extraordinary decision by POTUS Trump to fire the head as BLS following the week report. But this is the kicker here. Nomura Econ on ISM. We don't usually focus much on ISM manufacturing employment, which is manufacturing side, so this is supply side. But it's worth noting that the weakness is being driven by a rising share of businesses reporting employment reductions rather than slower hiring. The share of respondents with negative employment growth ticked up to 25%, the highest since summer of 2020. Now, that's an interesting one, because I read that and the first thing that I thought about was, well, the market is just adjusting, right? From an environment in which trade war tariffs were a focus. Well, employers are not just jacking up the prices of stuff on the table, or goods and services in general. What they're doing is they're firing people. right? Simply, I think the modern day employer, if they can't afford someone, they're not going to keep them around, especially if it is in a frictional employment sector, right? For example, just odd jobs or lower skilled jobs, right? The person would just be like, okay, I'm just going to fire them and get something else to replace this person, right? So we're seeing, I think, a little bit of a contraction in the job market, but that's because of the effects of the tariffs that are rising the cost of goods sold, which then employers or business owners are deciding, instead of passing the cost on to the consumer, which was already supercharged by inflation in the past 2 years, where prices are still high, right, of things in general, they're like, okay, well, I can't afford this anymore. I'm cutting off this specific person. Now, this is coming off of the times where people overhired before COVID and then went through a mass firing during COVID. The market somehow stabilized a little bit during 2022 and 2023, but now in 2025, I think there are a lot of businesses that are making choices to cut employees before they kind of get into the next phase of the market where liquidity will start getting abundant again and then cheap again. So let's talk about that. Okay, overnight repos, not really anything to note out of caution here. Just on 30th June, there was a more than 450 billion overnight repo, which means this is injection of liquidity into the system through overnight systems or mechanisms that the Fed has. Money supply, just the last time that we looked at this, it was just about to break out of highs, and now it has broken out of highs. So you can see that M2 money supply is back into growth, and this chart and this chart is very correlated. As you can see, it's not only just important to see the inflow or the increase in money supply, but it's important to also understand the velocity of that M2 money supply. So we want to see with what kind of force is that money moving into the system. And lately, that has been on the rise. And we'll see if this continues to move further upward, or is M2 going to contract a little bit before eventually moving further higher. Because remember, in order for the Fed to perform quantitative easing, what does that mean? That means that they're going to put more money into the system. And how will they do that? They will do that by purchasing bonds, right? In the open market. And so this is going to naturally result in expansion of M2, and then also expansion of velocity of M2, which is the speed of which M2 is increasing, right? So project this to go further higher by next year, which currently it's at 22 trillion. This will probably go higher, right? So you can keep note of that, and as we go along, I'll keep showing you this dashboard, and you will see how it changes, right? Now, at the same time, the Fed has been on its massive balance sheet unwinding ever since the peak of 2022. This is where interest rates started to rise, right? Where was the balance sheet back then? Well, it was around $9 trillion. That was how much the Fed took on its balance sheet, okay? And then they went on a big unwind with interest rate increases, and then in 2023, they again took on a sharp, I think this was some banking related activity that happened, right? There was a bank fiasco, some bank fell under, something happened, right? And then again, back, they've been sliding, taking all of these assets off their balance sheet. Now, once again, this will start to come up again as the Fed goes into a QE bind, right? So this will kind of look like this, and then it'll go like that also, and then back down again at some point in the future. But so the balance sheet is unwinding. That's a good thing. This sets us up for a potential rate cut in the future, right? And so market signs are all pointing towards that. CPI year over year, we peaked in 2022 September, and now in 2025, we are almost back to normal levels, but we are sitting very, very just slightly above 2% at 2.2%. So inflation is almost all back to normal, right? And then at the same time, jobs, right, is doing just fine, right? And at the same time, money supply is increasing, right? At the same time, liquidity is still no problems at the Fed, right? And CPI is normal. And the Fed funds rate is at 4.33%. It's 4.25 to 4.5. So the rate, that's the range, right? It's currently at 4.33%. And at the same time, balance on trade, we have had a massive influx of trading revenue for United States of America, right? We were in a deficit of 137 billion, and now it's a deficit of 70 billion. So, you know, that's almost 70 billion recoup in deficit. Okay, that doesn't mean that the US is still not running a deficit. Remember that countries that are leading or growing at a very fast rate will always have deficits. That's just the way things work, right? Because they're exporting a lot more than they're importing, right? Oh, sorry, they're importing more than they're exporting, not exporting more than importing. And US is a big importer, right? Now, Bitcoin, that's your second thing that you need to look at, the risk barometer. How does the market look like in terms of risk taking? Well, broke out of previous highs, which was a very important high here, right? And now we're coming back to retest those highs to perhaps turn this into support, right? So you may see a kind of a potential bounce in this area, but this is your rejection right now, which will now change into potential support. So this area now becomes a potential area for buyers to step in. If you break below this area, if you break below 104,000 and continue drilling down, then 100,000 or 97,000 here is basically the next support. So you have two supports, main supports here. The first being 103,000, and then the next being 97,000. That will be the two next supports on Bitcoin. In terms of extension targets, you have the 23.6, which you already hit and pull back. The next up will be the 38.2 Fibonacci extension at 126,000, and then the cycle of this wave more than likely will see a 61.8 extension at 135,000. That would be the target. Now, by when, I do not know. I do not own a crystal ball. I cannot tell you that answer, but that's the plan so far. China, looking pretty good these days. Breakout, pullback, breakout, pullback. The pullbacks are wild, but, you know, still heading higher. Target for this market currently, based on previous cycle wave, we just hit the 23 and 38, and next up will be 27,000 up here. And that's not super far away from all-time highs, right? So that, I think that when it does get up to the 61.8 here and breaks it and then firmly finds a support at the 38 and 23, eventually, this will then set up China to run into, you know, later times. And usually this will actually be on the back end of a expansionary or QE policy from America. Because remember, more money in the system, more money going around, more money can float to other countries, and, you know, it's more of a global phenomenon, right? Okay, now, some important things before we continue into technicals fully. CME Group, you can go look at the probabilities of the federal funds rate cuts. 92% chance now for a rate cut in September. This was just 80-some% yesterday. So it's getting firmer and firmer. And then in October, the market is pricing in a 62% rate cut again. And then a 50% rate cut chance in December. So by the end of the year, the market is pricing in 2.5 rate cuts. My view, I think that very likely that we get 1 to 2 rate cuts. This has been my view since the start of the year, since the market was at 8 to 9 rate cuts at the beginning of the year, when I was telling everybody the market's mad, right? No one was kind of batting an eye at that, but that's fine. But these kinds of things you kind of understand over a long time of following the data, understanding what the context is in the market, etc. Right? So now, having said that, look at the yield curve, right? Your traditional yield curve goes like this. Inverted yield curve goes like this, right? And so where we were, we are kind of reversing out of it, and it looks like a lot of crowding in the 1 year to 5 year range for notes, especially 2 year and 3 year being the most dominating in terms of what the money markets want to own in terms of treasuries, right? So how do we know that? Because the yields for these are so low, right? When the yield for something is so low, that means that a lot of people are crowding into this trade, right? That means a lot of people are buying bonds to cause the yields to come down, right? However, the 20, 30 year long-term duration bonds, they are the least bought right now. And the reason for this is because interest rates are so high. So over the next, 6 months, 1 year, interest rates are going to start to drop. And what will happen? This will start to then adjust downward, right? And then this, right, which was from, like, it was kind of going like this for a while, right? We had an inverted situation kind of for a while. This side, the shorter term duration, will start to come down as well because interest rates will start to come down. So you'll see these two left and right tail of the bond market will likely come down further, and then you'll get a flattening of some sort over here in the medium term. Okay, this will start to pull up a little bit. So as that environment changes, you can see the 20, 30 year bonds will get sought. These will be the things that people will start to look at to purchase as interest rate unfolds, or rather gets cut. And then this side where you have the 1 month, 2 months, 3 month, or RRP, which is your reverse repo, which is overnight, right? Those are currently paying at 4.25%, for example. These will also start to come down in terms of rates, which means the bond prices will start to go up. Okay, so that's how just this entire visualization of the bond market works, and it's a good one to kind of have in your back pocket to try and understand how the economy is going to shift, where is the funding liquidity going to come from, etc. Okay, now in the interest to keep this video, within 20-30 minutes, I'm gonna very quickly pander over to some of the setups, things that I'm watching, things that I like. Now, also, another thing that I wanted to mention was that where are the sectors in terms of the year? Okay, I mentioned this in the pre-market session yesterday, but if you look at year-to-date performance, year-to-date means from January this year to now, and then 1 year performance means year over year from August last year to August this year, right? So these are two very different charts. If you look at year-to-date performance, the best performing sector is actually utilities on the back of strong AI thematic trend, meaning because of the fact that AI is such a strong trend, utilities have been a sought out sector. I spoke about this trade idea a very long time ago and have been long in utilities for a while now. You can see how utilities have been surging ahead. This was the first alert for bullish entry for AI surge demand. Second alert was here. This is when I alerted everyone about utilities being a long sector for the foreseeable future until AI demand comes down, right? And this thing has just been chugging along, right? It's a safe sector to own. It's one of those things where, you don't really need to put in too much of analysis. Communication services is next, then it's industrials, then it's technology. So for year to date, that's your scores. If you look at 1 year performance, then technology is second, financials third, and then utility is fourth. And if you go into just the 3 months performance, then technology is the best performing sector because we had a huge tech rally with semiconductors leading part of it, which was also class 2, class 3 semiconductor market, which were servers, racks, all those kinds of other stocks that were moving as well, right? So there you have these sectors that have been moving. What are the sectors that have been lagging? Healthcare, consumer cyclicals, right? Consumer defensive, basic materials a little bit, right? So you can see those have been the main ones that have been lagging. Okay. Healthcare is a major lagger for year over year, which is down 12% versus the rest of the market, which is up 20 to 30%. And so it might be a good time for some of y'all to look at healthcare. Now, I'm going to put out two very prominent opportunities One being NVO, Novo Nordisk. Valuation of this business was done not long ago, and I can tell you that the multiples here are insane, right? And if you just look at this from a long-term perspective view, where you don't need this capital that you're about to invest into this for the next, let's say 5 to 10 years even, right? What is your risk to reward ratio here for a long position where you are, right? You're taking, like, let's say even you went a little like further down here to like $40. If it breaks $40, then I'm gonna add a second position or something. Like this might be your first position, right? Your second position could be at $40 perhaps, right, after taking a big haircut. And then your third position could be like if it gets down to like 30, right, something like that. And you allocate capital in tranches, so you buy some here, and then some here, right? And if let's say it gets to here, you buy some. If it doesn't get to here, that's fine. If it doesn't get to here, that's fine, right? And if you see it come to here and then it reverses, well, you can always add some here, right? And then you don't buy any more after that, right? But if it comes to here, then you buy some, and then it comes to here, you buy some, and then it doesn't get to here, that's fine. Well, you can always buy some when it comes back to breach this level here, right? So you don't need to stress about when you enter. Oh, I need to enter all my positions all at once. I don't want to have the stress of having to add it again. Oh, but what if I fuck it up? That's all fine, right? You don't really need to worry about that. What are you trying to actually like fight for? What is it, like $1 here or $1 here or $1 here? Nobody cares about all of that, right? Try to get into your investment in a generalized area. Within this gap, within this area is where I would like to purchase this stock, because then my upside is huge, right? I have an almost 11 to 1 risk to reward ratio. Even if I stretch this down, I still have a 5 to 1 risk to reward ratio on equity, okay? If I were to average into all of these positions around here, my risk to reward ratio is still 1:5. That is a great outcome for me. So from the perspective of valuation, in terms of how this company owns patents, has long-term possibility to bounce back, and it's one of the biggest pharmaceutical companies in the world with a 212 billion market cap, trading like a shitcoin, I think this is a great purchase. I can get into the financials in a separate video, but I've already gone through the financials with everybody on Discord, right? So just having said that, this one's a good buy. Another one is United Healthcare. Now, this one might go down a bit further, and you might even get a bigger discount on this, right? Once again, great business, has great cash flow, 218 billion market cap, right? Just being sold off out of irrationality, fear, markets meltdown, news, right? But it's currently undervalued. And if it gets down, like for example, to around 209, I will add some more. If it gets down to 186, I will add some more. If it gets down to where it is currently, I would buy some, right? Now, full disclosure, I've already added both of these positions to my portfolios, right? I just added Novo Nordisk today to the small portfolio. You can see it here now. I just purchased it, right? But on the big portfolio, I've already had it there for a while, like almost 1 or 2 weeks. And I already mentioned that in our Discord, right? So UNH is another great one, also undervalued. I have the valuation done. And so these are two that are lagging in the healthcare sector, which is a sector that's already lagging. So if the sector bounces back, even if the sector bounces back a little bit, these two will find a little bit of reprieve. And when the narrative changes and this reverses and reverts back to a little bit of a mean, there's some money to be made there, right? I don't need UNH to go back to all-time highs. What I do need is just for it to move up into the $400 to $500 level, and then I can kind of double up my capital and leave, right? I don't need this to get up to all-time highs. So, but no, obviously for all retail traders, I want every single dollar in the trade, right? So just don't do that, guys. Don't try to aim for, penny, every single penny. Okay, now jumping back into just general market views. Now, this pullback that just happened was all of 3%. That's nothing for a pullback. Of course, the market can go further up and then move further back down. May I remind that 6,100 or so is still 5% correction, which is very normal in a bull market. And for NASDAQ, that would mean a 6.5% correction, because this was actually a 4.37% correction on NASDAQ. So if we reject again further higher and then come down again, then the target is going to be 22,000 on NASDAQ, 22,200, and 6,100 on SPX, right? If we break higher, then you guys already know the targets on here, right? And look at the 10-year yields, right? So where the 10-year yields are currently at 4.2%, we're in a big downward channel potentially, right? That has been rejecting, and now this needs to break further down, because when the yield goes further down, what goes up? The bond price goes up. And what does that tell us? That tells us that the market's now pricing in the possibility of a further rate cut, right? So then you will start to see TLT, which is your 20-30 year bond, start to move further higher. So there is another trading opportunity here on the break of the 10-year yield further down, right? If the 10-year yield gets further down here and starts rejecting this 4.2 or 4.2 to 4.25% range, right? If it breaks and then starts coming back to reject this, then you can go long bonds as the 10-year yield starts to fall into 3.9. This would be coinciding with about the September rate cut, October rate cut, potential November, December rate cut, not November, sorry, Fed takes a break here, October and then December, right? So that'll be till here. So you like to see this like go down and then go up and then go down and then go up and then go down, something like that, right? Obviously not that much because this is a daily chart, but you get what I'm saying. We're moving in that direction, right? At the same time, the dollar is just kind of hanging out here. And if the dollar moves up, that's going to put a little bit of pressure on equities, because then that makes equities more expensive to buy. But if quantitative easing is announced at the same time, that should, you know, give a little reprieve. Now, the VIX was interesting. It did pop a little bit 2 days ago, whatever, 1st August. And then yesterday firmly came back down as the S&P 500 almost had a inside day, almost, but didn't in the end, and closed above. Let's see if it can continue the session further higher, and if we can get a rejection higher. If it breaks this high, then it's likely going to go even higher, right? And so that's all I have for you guys. There are some solid thematic plays that are coming out. I highly recommend that, you know, you'll start looking at some of these setups. There are a lot of nice setups that are forming. I think I'll do a whole separate video with just setups. But this is your macro update. This is your, you know, major update in terms of market. I'm back. I will be putting out videos more frequently. If you want more videos frequently, drop a comment. Let me know that you're watching. I want to know who's watching these videos and if you stay till the end. So I'll see you in the next one. Take care and peace.